On the 100K portfolio that I mentioned, and I'm not at home. I've been doing a lot of traveling, and when I get a chance to settle in at home and really focus on this, then I'll be able to produce a video with much more detail. But I do want to do a quick catch up. So, what we're looking at here is an Excel sheet of the position breakdown in the 100K portfolio. I simply exported this information here. I filtered or I sorted by symbol, but some of these symbols have quite a bit of pieces in them. So when I do it this way and I export to an Excel sheet, I have the following. And if we take a quick look at the top row, symbol type, so it's going to be stock or an option. Quantity for the options, there's an expiration date with days to expiration. Strike price, and all the relevant information detailing the position. Now, one thing I want to mention is I want to briefly discuss beta as it relates to hedging a portfolio. So if we take a look at, or positions in a portfolio. So if we take a look at something, let's go to the top, or let's go to row 2, and note that I have highlighted CBOE. I have 50 shares of that stock. Last price, or at least as far as the spreadsheet is concerned, was $221.43 a share. Okay, now let's say we have a portfolio. Note that various stock positions other than CBOE, I have DraftKings, 200 shares of that. There's 100 shares of Hood. There's 200 of Intel, 100 of Kraft Heinz, 100 of Mondelez. I have 200 of Modern A. Normal people would probably call it Moderna. And 300 shares of NU. Now, for a number of these positions, I have sold calls. And when you sell a call, that's going to produce a credit for you. And then for a couple of them, there are some individual put hedges. For example, in DraftKings, I do have some puts to give me some downside protection. But overall, I have a number of shares of different stock. And if I insure this portfolio via puts and I go to the individual shares, it's going to be quite expensive for me to do that. So I want to defray the cost of the insurance by finding a proxy for all these stocks. And what I did, or what I have been doing, is I've been going to the SPY. And I've been using the SPY because this ETF serves as a proxy for the S&P 500. So if you're a few steps or perhaps a block ahead of the parade, you're going to ask yourself, well, if you have 200 shares of Moderna, how many shares approximately is that in SPY? And that's a very interesting question. Now that's where we get to this last column over here, which is beta. I'm highlighting column R. And what beta is a measure of correlation, which basically tells you how things move relative to each other. So let's say the SPY is, we're going to use that as our example. That's my proxy. So the SPY, we're going to use the baseline as 1. So if CBOE has a beta of let's call it 1.25, that means that CBOE is going to move roughly 1.25 times the SPY. So if the SPY goes up $1, this will probably go up $1.25. If SPY goes down $1, then CBOE will go down by $1.25, approximately. And the data or the numbers that they use to calculate a beta are usually, sometimes they vary, but they take price action, price movement, volatility over the course of a year or more. All right, so we have a beta of CBOE of 0.26. So if we take the 50 shares of CBOE. So we're going to take 50 times the price of the stock, which is 221.43, and we multiply that by the beta, which is 0.26. We get the following number, 2878.59. And let me make sure, I believe it's 0.26, the beta. Yeah. Okay, so it's 0.26. And the beta times the price per share times the number of shares is 2878.59. And if we divide that by, what's SPY trading for? Let's call it 562 a share. If we divide this number by 562, that's going to give us 5.12, so approximately 5.12 shares of SPY. So that what this is saying is that 50 shares of CBOE at a price of 221.43 with a beta of 0.26 is approximately 5.12 shares of SPY. All right, cool. But keep in mind, in this particular portfolio, I have a number of different companies, and for each of those companies, I have a number of shares of stock. So how would we use this information to produce a number of SPY shares that the portfolio represents? So let's say we're going to use SPY price of 562, and I'm going to tell you why I'm writing that in a second. I'm going to put SPY conversion here. Okay, let's continue. So what we're going to say is that I want to look up some information, and I want to calculate how many shares of SPY all the stock I have in this particular portfolio is worth. So I'm going to say that equals some product. There we go, some product. And I'm going to use double negatives to convert the information I'm looking for into true-false statements. So B2 through B43 equals this T3, and I better make sure that I do that so we don't have a problem. I don't think I have to, but okay. If B2 through B43 equals T3 stock, so I'm basically filtering for stock, not options. I just want the stock. Then we're going to multiply what's in this column by the price. So I need column C and H. Then we are going to multiply C2 through C43 times H2 through H43. Is that right? H2, let's see, there's a price, there's the number of shares, and we're also going to multiply by the beta. So C2 through C43 times H2 through H43 times R2D2 through R43, and then we're going to divide that number. We're going to divide that number by 562 by U2. Okay, and let me make sure I don't have a problem with that. And that will give us the number that I'm looking for here. So what this formula is doing is I'm hunting column B2. I'm hunting for stock in column B2. So note that this double negative converts this into a true or false statement. And if it's true, I'm going to get 1. If it's false, I'm going to get 0. And then it will allow me to multiply this and right now I'm isolating CBOE, this times the number of shares, so number of shares times the underlying price times the beta, and we're dividing by the price of SPY to give us a conversion for SPY. And what this is producing, the output here is 84.59. So what that means is that each of these stocks has a number of shares, and when we total them, the aggregate, using the beta, that means that all of this, anything that I have, any stock that I have in this portfolio, the sum of all these is roughly 84 shares of SPY. So when I'm hedging this portfolio, I'm basically saying, hey, I want to insure 84 shares of SPY. And if I go to SPY, let's say that I want insurance for basically the next month out. So let's go to May 30th, which is 29 days away. And we see that SPY is currently trading around 562. So if, let's say I want insurance to kick in at 10%. So a 10% move to the downside would be $56. So that's going to take us to roughly 504, 506. So in this area, let's just say 505 to make it easy. This is roughly 10% away, 10% move to the downside. And if I buy one of these, then this insurance will kick in. So let's say that the market does move down. Let's just say magically we're going to simulate the passage of time. And we're jumping ahead to May 30th. I buy this today for $1.90, and I'll buy one because one contract represents 100 shares. So you can say I'd be a bit overhedged, but I'm not worried about it. This is just an example. So if we simulate the passage of time, this will roughly be trading for about $12.20, ceteris paribus, all else being equal, and it cost me $1.90. $1.90. So I would make $1,000 on this one contract should the market move down 10%. And what this does is it provides me with insurance on the approximate 84 shares of SPY that all these positions are worth. Now again, why am I doing this in SPY instead of going to the individual stocks? And the reason is because this is a lot cheaper. So not only am I paying less to insure it this way, but I can also sell calls against the positions. So for example, in Hood, I have 100 shares of Hood, and I sold the 47 call. I sold that for almost $4. This is $391 represents $390. I sold some calls in Intel for $40. KHC, I sold a little bit there. Sold some calls there in Mondelez. Picked up $82 there. Now, remember I said the SPY insurance cost me $190, but think about all the money that I'm bringing in from selling these individual calls. It's going to be much more than the cost of the insurance, so it produces a bit of profit for me theoretically, as opposed to insuring each of the individual products, which is going to be a lot more expensive. Now, some of them I have done it that way. For example, you'll note I have some puts in here, and I did it for DraftKings, but not for the individual stocks. However, remember, we're looking at insurance that expires at the end of the month, so roughly a month away. This is $190. But let's say if I'm going to spend $190 on this, okay, by purchasing a put at 505, how else? What other ways can I spend $190? Look at this brown column here. This is basically saying the expected move for the next month in SPY is going to be roughly around $25. That's what the market expects. So from current prices, we're expecting $25 up or $25 down, roughly a 50% range. So on the upside here, this is going to be around 87, roughly. So 587. And on the downside, $25 down is going to give me roughly 37. So we can see that's the expected move to the downside and the expected move to the upside. But let's say that I wanted to go out to, instead of buying the 505, let's say I'm going to have some confidence in the market's expected move. So I'm going to do this. So this cost me 90 bucks. This is 92 cents. And let's again simulate the passage of time. Let's say at the end of the month, May 30th, SPY is trading at 535. 535. And if that's the case, this spread is going to go out for a $500 winner, and it cost me $1.90. But originally I was going to spend $1.90, so say that I did this. This is $1.97. This is $2. So if the market goes down to 535 at the end of the month, and let's say it's roughly 25 divided by 562, it's going to give me, this is a 4.5% move from current prices to here. So if the market goes down there, this 10 wide spread is going to be worth $1,000, and it's costing me $2, where my first peek, my first look was just buying the 505 on a 10% move to the downside and having this kick in. So if it kicks in here, remember it was going to be worth roughly 13, which is where it is currently trading, or roughly, let's just say 12 something. And if I paid a little less than $2 for it, I would make $1,000. But here, I could make $1,000, and I'm paying the same price, and the 1,000 kicks in much sooner. Goes to 535, and I make $1,000. If I just buy the 505 and it goes down there, this put will be worth $1,000, but this will kick in, and I'll have the $1,000 at 535. And the market is currently saying that it's more likely that this scenario happens than the market going down to 505. Now, anything can happen. It can go up a lot more than it's currently trading. It can go down a lot more, but this is just another way of looking at how to spend the money on insurance. And not only that, as I was mentioning, you could spend a lot less by using the SPY as a proxy, or at least I'm doing it. I'm putting my money where my mouth is. I'm doing it that way rather than insuring each individual component and having that cost me a lot more than doing it this way. And again, remember, I'm not suggesting that anyone actually do this. This is just the way I do it. This is the way I look at things. This is the way, this is what makes me comfortable or uncomfortable. I'm going to do things that most people won't, and other people are going to do things that most other people won't. But anyway, what I want to get at in this short video, which has ended up being longer than I wanted, I have all this information. I have shares in companies, and if I'm going to insure it, I have to have an idea of what it converts to, what the portfolio converts to in terms of SPY. And again, this is my conversion number, and here's a simple formula I used to get there. I'm not going to go into the details of the double negatives and true false and blah blah blah, but this is pretty easy. Take a peek at this. You can play around with it and come up with it yourself. It's very easy to do because not all brokerage firms provide you with an individual beta number. So if you have to look it up, that's one a beta adjusted number. If you have to come up with it yourself, you can do it very, very easily. And I just showed how to do that. All right. Yeah, that's going to be it for this. As I mentioned, I have been busy traveling, so I haven't been able to settle in, but I did want to do a quick catch up on what's happening here, and I'll get into more details later. All right, that's going to be it for now. Thanks for tuning in. I'll catch you guys next time.